Record this for posterity. Okay. So again, this is our webinar and discussion about trading with confidence. So I thought what we do is we start off. I always want to find out who exactly is listening and what exactly is what you're doing. So there's a quick poll that's showing up on the screen right now, and if you would do me a favor, just tick off the answer to this question of how you're dealing with the market as investing. Are you just buying and holding? You're riding the trends, looking for reversal points. This little poll that should have popped up on your screen. I'll kind of tell you a bit about what's happening in terms of the who's doing what and whatever. So far, we have most people are riding the trends. Some people are looking for reversal points, but about 60% of you are riding the trends. 43% of you are looking for reversal points, and about 42% watching for breakouts and breakdowns. That's good. I mean, riding the trends is probably one of the best ways to work with markets right now. I'm going to kind of continue on with this concept of, okay, if we are riding the trends, we're looking for reversal points, etc. Tell me, what is the current trend of the market now, in your opinion? So we have 55% are, well, actually it's moving around. Hang on a second. About tied with downtrend and no trend. 18% of you say uptrend. And it looks like no trend and downtrend are kind of in the neck and neck right now. It's interesting because it is a big question to answer, where are we in any given market condition? Because, about 75% of stocks will follow the market on whatever trend it's on. That's just the way it goes. You can have great stocks that are doing great things, but oftentimes if the market is not cooperative, the fact of the matter is that you're not going to have the opportunity to really make a lot of money because the trend is really most of the action. But I will tell you, though, that there is about 48% of you said there's no trend, and I would really agree with that. And we call that, in a different way, we call that a chop. Kind of a chop going on, right? It's kind of up, it's kind of down. Look what happened today. Markets are down 1.5% on the NASDAQ, 1% plus on the S&P, and then out of nowhere it starts moving up. For what reason? I don't really know. So the bottom line is that you can basically look at different concepts of where the market is to give you some action ideas. Let's kind of get into some of the discussion here and talk about some things that we had been talking about. In our last webinar, last month, we talked about this whole idea of looking for breakouts and breakdowns, trying to find some things that, depending on their particular positioning in the markets, what was happening. In other words, we were looking for opportunities that maybe would present themselves, and it didn't really matter what was happening with the markets. So we were looking at things like breaking up, breaking down. This is a program that we have where we send out alerts to people. Many of you may be involved in it. Basically, the goals of the alerts are to eliminate one side of the trade. What we want to do is we want to find, okay, where do we want to be in this particular position in the stock? Is it a long trade? Is it a short trade? Where is it going? Is it breaking down? Is it breaking up, etc.? And basically looking for limiting risk with some very specific areas and at the same time maximizing reward. And we do that through an algorithm. So many of you know this. If you don't know this, is a 14-day trial. You can check it out. We'll kind of leave that up to you. You can go check it out afterwards. Basically, this is just a sampling of what the kind of the alerts look like when we're looking at them from our side. We're looking for these very important levels where stocks will break out and break down or consolidate through. This is JCPenney recently, and we saw that once it kind of broke through our resistance line, it didn't hold anymore. It kind of broke up really nicely, and we can see that back in January. And then at the same time, look at May, when it broke down through all of our support points, it really got whacked pretty good. So we're looking for, again, a defined support, resistance, and breakout. Now, this is different than what we're talking about today. I just want to do a little refresher. This is different than what we're doing today. The idea today is a little bit of, okay, well, where's the trend? How do I know the trend? And how do I hop on the trend? Okay? So in this scenario, when we're looking at alerts, the trend doesn't really matter. The trend is really not the issue that we're really dealing with here. The trend is more of a concept, of what we're looking at to find, a bigger, more significant long-term play, or something that may be reversible. In the alerts, what we're talking about is one-offs, okay? And this is kind of like what we're showing in terms of a volume-based area when we're looking at our alerts. You can see the areas that have holes in them. You can see the areas where there's very little volume. They move very quickly. And again, this is regardless of where the stock market trend actually is. And I'm just going through this quickly. If you haven't seen this yet, the presentation that gives you all the details on alerts is on the Trigger Point Research website, and you could just play it and see exactly the fine details of all this, okay? Let me kind of go through here. Another example when we combine it. Now this is important because it's going to lead us into our next discussion. What we have here is, if you look at the top part of the chart, we see is obviously the various important points that we have calculated to be support resistance, low volume areas. But on the bottom of the chart, what's important to look at there, and I'll kind of bring that over here, this area here. My screen just went kapooey. Okay, now, I went through that quickly. I want to talk about something more important, something that's really cool, because a lot of times, again, if 75% of the stocks in the general markets are going to continue on a trend or a direction, or directionally moving with regard to the market trend, well, what is the market trend? It's something that we've been working on for some time, and we've come up with what's called a market trend indicator. And this gives us a really good idea, a really good indication by using a lot of different inputs into what is the actual trend of the market. Because, yeah, we know the trend. The trend could be, let's say, just an uptrend if it's following a 50-day moving average and just moving higher over time. It could be in a downtrend that we see because we can say, okay, if you connect all these points, it's moving lower, etc. But the fact of the matter is there's a lot more that really goes into this, because you want to look at things that are consistent in terms of some volume issues, participation, longevity of the trend, etc. So what we did is we created a market trend indicator that will show us when is the market really breaking down? When is it really showing us that, hey, the trend is changing from a downtrend to an uptrend? Where do we look at it not just from a short term but a longer term? And where can we have some commitment that, hey, you know what, if it is in an uptrend and it is breaking down a bit but not actually getting so far to a point that it breaks down entirely, well, can we add to things on those dips? Because that's really kind of an important area. So with that, we looked at a variety of different places to put together, and we created this market trend indicator. On top of that, it's important to look at what we would call a key reversal indicator. There's another thing that's really important to look at, because how many times have we seen lately markets are moving in one direction, then all of a sudden the next thing you know, just out of absolutely nowhere, it turns around and, they just rip it out and move forward, and it's moving down for a day or a week, and out of nowhere, markets all of a sudden are up 3% the next day. Frustrating, because it kind of takes the idea of what's happening with, trends, and if you're trying to invest on a trend, it throws all that out the window. And it makes it kind of meaningless to utilize that, because what's happening is that you just get, essentially killed in one day if you were short, or if you were long, the same thing if it turns around immediately. So where is that point? Where is that key point of when a market is overheated, when it's really at a point where it really is just way out of whack on the upside, or it's way out of whack on the downside and it may be turning? So the three things that we work in our market timing model are, okay, what is the world doing, from a big picture? What is the market trend saying? Where are we? And a key reversal indicator. And the important thing about the key reversal indicator is that when you look at the market and you find a place that there is this overheated or oversold area, these are times when you can tighten up your position, or you can actually do a counter trend trade to profit. Because obviously what we want to do is we want to predict a long, short, and a medium-term market trend, and if you do so, you can make some very quote-unquote easy trades. I don't mean easy in terms of just easily making money, but easy trades as in, you could be, okay, long, and we could say just very simply, just buy an SPY ETF or a small cap ETF, whatever it may be. We could be short and very easily just put that trade on and then ride that trend correctly. Because if we could do that accurately, if you could do that accurately, and you can find the times where it's a good time to invest and to find when the market does in fact have indications of turning, you can be that much more successful. So it seems. Okay. And the basic point is we want to make this easy, right? So how do we make this kind of in a way so that it is easy to work with, so you don't have to do a lot of questioning. So what we did is we put together, again, many different calculations. It's not so many that it's overly complicated. It's not so many that it's overly, I would say, massaged, we'll put it that way. What it is a way to look at it so that we can say, okay, yes, this is a confirmation of a market trend that is moving in this direction. Or we can say, yes, it's just a counter-trend rally or counter-trend breakdown, whatever it may be. All right, so what we did is we created a variety of, we'll call them temperature gauges. Something that we can look at very easily and find out what is the actual trend. How do we take the pulse of the market? So the top left one that we're looking at here is a market trend indicator. And that particular one is that it's kind of in a neutral setting right now, which means that it's neither up or down. It's neither it's neither absolute. And the whole point we made before was the idea of, hey, there's a chop. And a lot of you said there was no trend right now. Markets are at equilibrium. It's a very much in-between situation where there really is no actual trend going on, and that makes it that much more difficult to invest. Because what happens in those environments are that you get this range of moves. You get this kind of range of highs and lows that can kick you out on a stop or can drag you in when you shouldn't be. Well, right now we're in that kind of a situation where you have a market that is in a neutral. It's in a not exactly trending up, not down, probably leaning more towards a trending up scenario. But then we go and we say, okay, from there, let's kind of look a little further. What is actually our key reversal indicator? Now, this is very important. So when we look at the trend, and then we look at our key reversal indicator. So right now we're in neutral, and the market's in an equilibrium, which means there is no favoring, there is no absolute edge to be either long necessarily or short. In this environment, anything can happen until we see the confirmation of that move. So right here we have two things that are very easy to look at. Okay, we know right now we should be in a neutral positioning, ready to move at the next move of the markets. We should be able to say, okay, we are going to be looking for a market that will then show us some potential oversold or an overheated mode to actually act on it. Right? Makes it easy. So you can see where we are. Now, obviously, we can have these two indicators, just the ones you're looking at right now, these two indicators saying, hey, you know what? The market is trending up. That's fine. But what happens if on the right side, our dial there gets in an overheated state? I'm going to show you what that actually looks like. When we look at a history, now this is taking the dial and looking at it on a historical basis. When we look at this and we say, okay, what is the history and how does it look? So now when you look at this chart going back to the beginning of June and you look at these peaks where it gets red hot, that would be the equivalent of markets being in an overheated state. And what happens oftentimes is when you see a very significant move to the downside. Look close to the 20th of June. See that big peak right there? Markets were way out of whack, way overheated, and they were due for we'll call a correction. And that did happen. You can see the black line right there shows how it did in fact correct. And then when markets became back into neutral, where that's the zero line, markets in equilibrium, what happens is, okay, fine, we're getting ready again for the next turn. And at that point, we saw that the markets were starting to trend up, and you kind of moved right back into it. Now, again, we saw the same thing happen about the 6th of July. Markets got overheated very, very quickly. And if you look at what happened since then, markets are starting to trend down, and now markets are back into equilibrium at this point. So now, again, you could have actually done 2 or 3 different trading positions on this, and you would have been relatively successful under this scenario where, okay, you go short when it peaks, and you go long when it drops. See back on 612, you look at where 612 is approximately. You look at the 6.1, you see where it dropped down, and it was very much oversold. And then 2 days later, it just moved up very dramatically. And then again, you see this chop happening. Now, what I'll tell you is that there is more, historically we've seen there's more accuracy in looking at market oversold indicators than there is in looking at market overheating indicators. Markets can stay overheated for much longer than they can stay oversold. And that's because of the very nature of markets. People, want to put their money to work. And when that happens, what you look at is the fact that, those are much more times that you want to either cover your short, or what you want to do is you want to go out and you want to actually go long, depending on what the broader trend is for the markets. Okay, so far so good. Now we're going to look at actually a little bit longer period of time. Now here's going back to 2011. So there's a lot going on with this chart here, but I want to kind of point out a couple different areas for you. Okay, so let's go way back here, and let's take a look at a couple of areas. Now again, what we're looking at is the key reversal indicator, which we calculate daily. And I want you to look at some of the peaks and troughs of this. Okay, so let's just start over here somewhere. Back in July of 2011, we saw a majorly overheating, almost the most we've ever seen if you look at the history back to 2011 of February. We saw a major overheating of the markets. Again, we get that deep, robust red color. We see that it's becoming a point that it is very hot, it is very problematic. We have to look at, okay, where is the market going from here? And from there, we need to make some choices. Now, look what happened right when that happened. You saw this big spike of the market, the black line, and then right where we peaked out, kind of got really crazy. The market just came right back down from about 1350 to about 1310 on the S&P 500. Okay? Now, oftentimes what happens is it takes a while for that overheating to kind of really bleed out, so you kind of had to come down a bit. Now, if you go a little bit further here, you would have kind of been in a short entry right about here, okay? Because that's what's telling you that there was a short and the market trend turned to a downtrend. Yeah, it would capture a lot of this, but look what happens here. Look what happens right about here. There's this majorly oversold scenario when this market came out, and you went from 1,100 and change almost to 1,200 in a matter of a couple of weeks. And then from there, you notice we went back to a market neutral, which kind of was right here. Then you got oversold again, so you could have been short. Right? And then you peaked out again. So this kind of was very bouncy inside of here. You kind of could have been swapping back and forth. You peaked out over here on the downside. Again, that correlates to one of these peaks right here. And then you slowly kind of started moving up higher and higher and higher. And then you peaked again on the overheating right here, right in about October. And the market came in pretty hard, cleaned itself up, went back to a market neutral scenario. The uptrend was then held. Now you have an uptrend that was going on. Now these here were just different because these were not reversals. If you remember what happened back in January, the market was heating up, but what happened there was that there was no significant change in trend. So you would have held a long position because the trend was long and possibly shorted or hedged yourself on some of these peaks here. But generally speaking, if you look at what happened here, the market, different than here, there was a market in a relatively neutral scenario there for a while. The only peak that happened was right about here. Market came down a little bit, but it kept on going. And in fact, if you look at this, it really kind of spun around very quickly. And then what happened was there was none, well, not accurate all the time. You didn't see everything. But when we peaked down here, there was a concurrent level of move in the opposite direction. Now, here's what's important. You can see right now in July, this is kind of a different look than what we saw a moment ago. But in July, what we saw was clearly an overheat a couple of different times. Markets went a little bit bonkers. And then what happens is now it's starting to bleed out. We need to get back to a market neutral, which we're very close to. And this has to come in a little bit as we see it. So, before you can actually make any progress moving in the other direction. So when we combine the market trend, the MTI, and the key reversal indicator, two different but somewhat similar and complementary indicators that we use, what happens is we can get a really good read on the market. And what we do is simply give the alert, if you will, that, okay, here is a market reversal point. You need to look at going long if you see any tick up in the markets, and then you enter the market and move with that. Very powerful. And what's more important is you can see from this chart probably the accuracy. It took a while. We built this. It's been taking a while for us to build this actual indicator, and we did a lot of back testing on this to see where exactly things would work, where they wouldn't work, and come up with a solution that would make sense to utilize for for investments and for actually utilizing in the real life of money, if you will. Here's illustrated the circles that shows you the peaks and then what happened after with markets. Now here's some exact, some real dates and some real things that did happen when it came to the key reversal indicator. So here's some samples. So there was dates, 3 different dates we're looking at. May 17, 2012. This is the performance of the various indices over the next 3 days when we saw extremely oversold conditions. So the S&P was up 0.9% 3 days after on May 17th. NASDAQ up 1% almost, Russell 0.7. May 18th, look at that. A significant amount of oversold, and again, it moved up 3 days later. And then November 25th, 2011, there was a dramatic oversold condition, and obviously there was a significant amount of move on the upside. Now, on the opposite, we look at overheating. We look at times when markets were overheating. You see on July 5th, 2012, there was a massive overheat, and over the next 3 days, we saw the S&P and the NASDAQ somewhere between 2 to 2.5% down. June 20th, 2012, we saw the same kind of overheating going on. Look how much we would have saved if we would have been either out or hedged out the position at that point. And January 19th of 2012, there was kind of a mixed call. That's that time I told you it was really hard to tell, and you can't get 100% accuracy on this. But it was a mixed call there, just a slight move on the upside. But the point is this. What we do with trigger point alerts is we look at individual stocks regardless of market trend, and we're finding breakout points, breakdown points, etc. When we're looking at something entirely different here, because this is a big picture where you can say, okay, I'm investing my portfolio in an ETF, whether it's the Russell or the NASDAQ. I'm in long, I'm out, or I'm short. Makes it a very easy transaction. Sometimes people like to invest in stocks. This is a more broad-based approach to the same situation. And actually it will end up being a longer-term trade with a lot less trades moving on. So it works as a complement to the alerts, actually. Or you can use this as a standalone. I think it's pretty cool how the accuracy of this, and we really are pretty pleased with this. Now here's the third leg of it. We're going to continually look at, okay, where are the areas that are quote-unquote hot or cold? And this is something that we publish as part of of this particular program. We want to look at what's happening with the world because there's a big correlation around the world. Usually when you see one market moving up, you often see another market because of just the general global structure, the nature of what's happening out there. And what we do is we're kind of looking at the heat map, and we go backwards, and we can actually see that changing and adjusting over time. And this gives you a very broad-based picture of what happened on a daily basis around the world, and we add that in. We can actually utilize the market trend indicator as well as the key reversal indicator on any particular market. So if it's an international market or domestic market, just the S&P or maybe the worldwide, it can be used because it's that robust of a processing of the system. So here you're seeing where the strength is, obviously. U.S. has been very strong. This is year-to-date now. Year-to-date, the darker the green, the stronger it is. And you can see the red is where the weakness is. Point is, it's a simplified trading strategy. We're looking for the market trend to say, okay, long, short, or neutral. Again, it's very much like the alerts where you'll get an actual alert. You'll actually get some information that says this is what you should be doing right now. Emails, via text message. And on the site, you can see, kind of track what's happening and where the indicators are on a regular basis. You can actually see those temperature gauges, if you will, or gauges, thermometers. We're just looking at 3 different very basic points. You want to be long, short, or neutral. Okay, then what you want to look at is the reversal, the key reversal indicator. Okay, well, if there's a short-term counter-trend trade that can happen, where do you want to be? You want to be in if we're long, do you want to shorten up real quick? Or if you're short, do we want to say, hey, you know what? Let's kind of flip the trade real quick until we can get the next side, get the up, and then move on. And usually what happens is with the reversal indicator, we have found, is it lessens your frustration because you know when those trades should happen and when they start to reverse. You know when you're actually finding that a market is in a certain direction and when it's so overdone on one side where the probability is that you're going to see buyers stepping in. And when you see that, that can really save you a lot of not only money, but a lot of headache and frustration because you're protecting your profit from the trending position, from the alternative trending position. Now, the bad news is it's not available right now. We're still going through a couple of different testings, but it's going to be available in about 30 days. We'll let you know about that. We'll have some additional information. We'll start kind of feeding some of the information on the Trigger Point research site. Anybody that's involved in this, we're going to kind of give you on a regular basis all the information that you need to have. But basically, you're going to have all these different components that we've talked about. Whether you're going to have to be short, be long. And again, this is a big picture. This is not for those that just want to be in individual stocks, but these are for where you can find the sweet spot of the markets to be involved in. And I'll tell you right now, I'm looking at the up-to-date latest exact points of where we are right now. Again, the markets are in a somewhat of a neutral to a downtrend as we speak right now. But our key reversal indicator is an equilibrium, which means that there is no real, we'll call it an edge to be long or short. There's both sides that can be actually entertained in the market, but the overall big picture look right now is a more towards a downtrend, which means that we can be sneaking into shorts and then adding to the position until we get to the point that we're in a confirmed downtrend. And then what happens is, again, if there is a change of status, if there's a change of the key reversal indicator, well, then you're going to get that too. So what I would encourage you to do is consider this market to be one of a choppy, non-trending market right now. And that means that you'll have the opportunity to be both sides of the trade. You've got to be quick if you're going to do it that way. But until the actual trade is confirmed, until there is an actual confirmation of any particular direction, instead of getting frustrated, what we could do here is look for the key reversal times and then figure out when those good times are to invest, and then when it is time to actually move out into the next, we'll call it the trend, into the next phase of the trend. Okay? So watch Trigger Point Research. We'll have this on there. If you have not already done the trial, the 14-day trial for alerts, it's available. Just go to triggerpointresearch.com. There's a little button there. 14-day free trial for that. And just realize that right now, this market, as we're seeing it right now, because of all the money that's being introduced by the Fed and the various governments around the world, we're going to see this chop continuing. Be very markets will be very mindful of the news, and be aware that you want to be able to be quick and know what the trend is without guessing. And that's the whole point of how we designed the calculation and the algorithm that we use to make sure that we can understand where the trend is or where the trend isn't. And here's the legal stuff that you need to look at. So we got time for about 2 or 3 questions. I'm not sure if anybody has any questions. You can always email me. Just send me an email if you want. Everybody probably knows my email address, or just send it back to info@triggerpointresearch.com, and I'll be happy to answer your personal questions on this. But again, what the big thing here is that it is all about market trend, and you need to be aware of that. You need to be focused on that. You need to understand that. That's what's going to make you money in this kind of particular environment. And I mean this kind of environment. This is the environment where that chop can really take you apart pretty badly if you're not mindful of it. Okay, well, hey, I thank you for joining me. We have another one of these little things coming up, and I hope during the time when we're actually going to be utilizing this, kind of just introducing this, you go check it out on triggerpointresearch.com. We'll make sure that we have some good information for you. Thanks for joining me. I appreciate it. Andrew Horowitz here. Listen to The Disciplined Investor, and stay tuned. We have a lot more coming.